A Fibonacci retracement confirmed by a candlestick signal normally is not a reason for me to initiate a new trade. I really like looking at solid support or solid resistance for me to be comfortable recommending going long on a new candlestick signal. A Fibonacci retracement is just not that significant, like a major low or a major high. So, for example, here we have the hammer confirming a 50% retracement. Would I use that to go long? No. Would I use it to lighten up or cover shorts? Yes. Okay. If that hammer confirmed a support area, then I would use it to go long. Okay. Same thing here. We have a doji confirming a 50% retracement. I wouldn't be using that to buy. Now, let's say we had, and this is not the case here, but let's say this was a prior resistance area, right? Old resistance should be what? New support. And let's say the 50% retracement was here, or even a 61.8% retracement was here, and then we had a doji there. That would be a reason to buy. Okay? Not so much the Fibonacci, it's because it's confirming an important support area. Okay, here we have a couple of bullish engulfing patterns near 61.8% retracement. I just rounded off to 62. And I tell you, if we didn't buy in the first bullish engulfing pattern, which probably would not, would we buy in the second bullish engulfing pattern, and why, or why not? Okay, so we had two bullish engulfing patterns there. Okay, the first one, or actually the first one, sorry, is probably a piercing pattern. The first white candle didn't look like it got more than into the black real body. So the first one is a piercing pattern. And the second one, I'm assuming, it looks like the trend is still down, although it traded sideways for a couple of days. But to me, the trend still looks mostly down. Why do we buy in that bullish engulfing pattern where we would not buy on that first piercing pattern? What's the difference? Didn't they both confirm the Fibonacci retracement? But what's the difference?
Because your target is not that much because you have a prior support.
Well, the prior support area, that would be one thing. But the second thing is, the reason we could think about buying on the bullish engulfing pattern, this to me would be minor. This to me would be, sometimes it's hard finding the pointer. So he's saying the prior support should become resistance, which indeed is true. But where is the more important resistance area? The recent high, right. So what we could do is use that red line as a conservative target with the idea that the more important target is the recent highs. But the point I want to try to get with this is that now we have the piercing pattern confirming the Fibonacci retracement. Once we have the piercing pattern, what becomes support? The low of the piercing pattern. Did the low of the piercing pattern hold with that bullish engulfing pattern? Yes. So now we have a piercing pattern and a bullish engulfing pattern, back-to-back candlestick signals at the 61.8% retracement. But it's the back-to-back candlestick signals that really would give me the reason to buy. If I just saw a piercing pattern at the Fibonacci retracement, the Fibonacci is just not that strong a signal. But once you have the piercing pattern as support, and look how nicely that piercing pattern held as support, even after the bullish engulfing pattern. Again, just you could look at this pretty quickly. As far as the text is concerned, Fibonacci retracement, Harami. Yeah, you can do. The question is to use Bollinger Bands. You can use them all the time.
But many times I see when it is trending up, it's always at the upper band.
Yeah. Okay. The question is with the Bollinger Bands. Keep in mind the top end of the, especially if the market's trending, or even if it's not trending that strongly, the Bollinger Bands, the top end of the Bollinger Band is going to be increasing, right? So yes, it's still, I don't want to say resistance, it's overbought, so you're going to have a correction if you get a bearish candlestick signal, but you could use it as just gauging if the market's overbought. So if it's trending stronger and you're getting a bearish candlestick signal at the top end of the Bollinger Band, I would still use it. Okay, candles in context. Remember, we're still looking at discipline. We're going through the letters, so we're now looking at C. Candles in context means that we're looking at the candles through the prism of the overall market conditions. So, case in point. Morning star. Now, look at the candles through the overall market conditions, which means risk-reward. Okay. If you're buying on this morning star, what's your potential resistance area. And I'll give you a hint by drawing the line. Now, one thing I may not have pointed out with the change of polarity, it doesn't have to be exactly the same lows. If you have a zone of prior support, like here, that's fine. You can have a zone, prior support, prior resistance. So if you're buying on this morning star, you're buying at a resistance area. Okay, why not sell at this doji? What's that? It's holding a support area. How do we get support? Prior highs, old resistance becomes new support. And this is why you really can't test the candles by themselves. If you tell your computer to sell every time you get a doji, you're going to get a sell signal on this. That should not be the case. Yeah. Okay, and this is what we saw before. Prior resistance becomes a new support area. Okay, and there are a couple of reasons. Well, there's one reason we should know not to sell. Here's a shooting star. Why would we not sell in a shooting star? Obvious reason. What? Old resistance, new support. And another reason, and I wanted to touch on this just very briefly, is the shooting star made a new high close for the move. Correct? See, it made a new high close. Normally, even if there's a bearish candlestick signal, if there's a new high close, I want to see a lower close under that close to confirm a turn. A new high close is pretty important, bearish candlestick signal or not. That's true of the doji also. Okay, we're not going to get that in the Forex, but in my non-Forex seminars, if the market's moving up and then you have a doji above that white candle, which you can't have in non-Forex, right? If the market makes a new high close, I want to see a close under the doji's close to confirm the potential bearish implications. Okay. Now, we saw this before. Anybody remember what this candle line is with a long upper and lower shadow? Remember as if one's hair is on fire? High wave candle, yeah. Here we have a high wave candle. The market's confused. And I had said before, here are a couple of other high wave candles. I'm going to show you a way to let us know which one of these high wave candles is more likely to turn. And what we do is, this is candles in context. Okay, I threw an oscillator on here, and I'm not sure which one this is, but an oscillator. And okay, the market's overbought here, hence vulnerable. Okay, is the market oversold here? Let me see. This might be RSI, because it looks like it's 30 to 70. Do you have it on, what is it? I think it might be RSI. It's not, we know it's not stochastic, it's probably RSI. It is the RSI, definitely. So, is the market overextended with that second high wave candle where I had the word oversold in question mark? Is it overextended on the downside? No. The high wave candle is likely not going to be that important. This other high wave candle, is the market oversold? Yeah. The market is more likely to rally with that. And then I don't know if it's quite a bullish engulfing pattern after. But this is one very easy way to do it. If you use oscillators, throw your oscillator on, see if the market's overbought or oversold, and then see if you get a candlestick signal confirming it. Okay. One way that the Japanese, and this works really well in the Forex markets, one way that the market can be viewed as overbought and oversold is by looking at record sessions. A record session is when the record session high is when the market makes a higher high. And we're looking at the top of the upper shadow. So first, the market has to make a new low for the move. And then every time it makes a higher high, not the real body, but the shadow, the top of the upper shadow, every time it makes a higher high, we count that as record session 1, 2. Now you see between 2 and 3, it didn't make a higher high, so it's not